Here's what most coverage of the bond sell-off got backwards. In early August, the United States and Japan bought yen together, their first joint operation since 1998, and it was built deliberately so that not a single treasury had to be sold. The fear was Japanese selling. The fact is the opposite. Here is what actually happened. Between the 1st and 3rd of August, Washington and Tokyo confirmed a rare joint intervention to buy yen, after the currency had slid to roughly 40-year lows. Al Jazeera, CNBC, and the Financial Times described it as the first joint yen buying operation since 1998. OMFIF's reconstruction puts the scale at roughly $85 billion over 2 days in late July. The design matters. Japan's finance minister said any dollar selling would be financed through the Federal Reserve's FIMA repo facility, precisely to avoid selling United States Treasuries. And the New York Fed sold euros, not dollar assets, a choice Goldman Sachs and OMFIF read as deliberate. Officials were so alert to the risk of Japanese Treasury sales that they engineered around it. Against that backdrop, the selling was real. On Tuesday, the 18th of August, the 30-year Treasury yield touched 5.323%, its highest since 2007, according to Bloomberg, Yahoo Finance, and the Spokesman-Review. It had already risen about 6 basis points on Monday to 5.31%. The 10-year climbed to roughly 4.7%, up from about 4.2 at the start of the year, CNN reported. Writing in the New York Times, the chief economic advisor at Allianz cited the 30-year at 5.27% and called this, quote, no ordinary bond market sell-off. And this is not an American story. Japan's 10-year yield reached its highest in 3 decades. Germany's 30-year borrowing cost is at its highest since 2011. France's 30-year trades at levels unseen since before the 2008 crisis. The same pressure is showing up across the world's largest bond markets at the same time. That matters for the explanation. No single government's politics, deficit, or central bank can account for a move this broad, and any account of the August sell-off that stays inside one country's borders is missing the frame. So what is driving it? Reporting from ZHNGN and CBS points to Middle East tensions in the Iran war, alongside heavy government supply and a wave of corporate borrowing tied to artificial intelligence. Some early operator lists cited only fiscal supply and tech borrowing and left the conflict out entirely. None of these forces is new on its own. Their combination, landing in the same weeks, is what changed the arithmetic for the investors who fund governments, and it is why this episode is being described as something more than a routine summer wobble. Start with the borrowing. Writing in the New York Times, the chief economic advisor at Allianz, citing Goldman Sachs, reports that hyperscalers have already sold almost $500 billion in bonds this year and will probably borrow a minimum of another $300 billion by year's end. His mechanism is specific. It is real yields that surged. The extra inflation-adjusted compensation investors demand, not a runaway inflation scare. His verdict on capacity, verbatim, quote, there is no way this bond market can fund all that the tech platforms need, all that the governments need, and all that the other corporate needs. Without higher yields, just doesn't add up, unquote. The same op-ed carries a warning, and it belongs to its author. Continued selling, he writes, could mark the beginning of a structural economic shift, more enduring and more globally consequential than most previous episodes of market volatility. That is his assessment on the record in his own words. It is not a measurement, and it is not this newsroom's forecast. We report it because of who said it and where. A widely followed market economist in the Times, and because the move beneath it, in real yields, is documented rather than asserted. Washington's response came on Wednesday, the 19th of August. The Treasury said it would, quote, at least double, unquote, its buybacks of 10, 20, and 30-year bonds from $2 billion to $4 billion per operation. 2 things are worth precision. First, the language is at least double, not more than double, as some accounts had it. Second, nothing has been bought. The operations do not begin until the 9th of September, and they run through the 4th of November. This is a schedule, not an executed intervention. On Thursday, the Treasury Secretary told CNBC the program could be more than $4 billion per issue. The market's first reaction was relief. On announcement day, the 10-year yield closed down 5.7 basis points at 4.647%, and the 30-year fell 9 basis points to 5.196%, CNBC recorded. The relief lasted about a day. By Thursday, the 10-year was back above 4.7%. CNBC's own headline described yields rebounding and wiping out the decline. Whatever the buyback program eventually does, its announcement alone did not reset the market. The first real test comes when the purchases actually begin in September. Here is a tension worth stating plainly. In the same week the 30-year Treasury hit a 19-year high, the benchmark mortgage survey fell. Freddie Mac's weekly survey put the 30-year fix at 6.65%, down from 6.67, and Freddie Mac titled its own release, Mortgage Rates Decline for Second Consecutive Week. Both facts are true. The explanation is timing. The survey's methodology lags the bond market, so it had not yet caught the week's move. Zillow's tracker showed 6.64%, up 14 basis points. Bankrate read 6.72 figures from their own surveys, which this newsroom did not independently confirm. The backdrop to all of this is the federal interest bill, mainstream projections, from the Committee for a Responsible Federal Budget and the Peter G. Peterson Foundation put net interest for fiscal 2026 at about $1 trillion. That equals 14% of federal spending and 19% of federal revenue, and it is second only to Social Security as a single line in the budget. One widely shared account cited $963 billion, a figure from the Times op-ed. Where that number appears, it belongs to that piece. It is not the consensus projection, and it should not be presented as one. So here is where things stand as of the 23rd of August. Known long-term yields hit multi-decade highs worldwide. The Treasury has announced but not begun larger buybacks, and Tokyo's intervention was built to avoid selling American debt. Not known whether $4 billion per operation changes anything, whether mortgage surveys reprice upward in the coming weeks, or whether the structural warning in the Times op-ed proves out. One bank research chief, in a CNBC interview cited by the operator dossier, and not independently reconfirmed by this newsroom, compared the borrowing pattern to paying your mortgage with your credit card. It can work for a while, he said, but eventually the mismatch starts to become more obvious. That is an analyst's analogy presented as one. What happens on the 9th of September will be covered the same way, sourced or not stated. Every figure in this report and the outlet that reported it sits in the written dossier at yieldshock.gothamweekly.com. This newsroom does not forecast markets, and it does not sell anything. The responsible editors named on that page. This report was human reviewed. If you want these files as they publish, subscribe. And a like helps this reach people who check things before they repeat them. Broadside News Group. Verified.